always, the views expressed during today's webinar are those of the speakers, not of Stratford, the speakers' firms, or clients, and are not intended to provide legal or tax advice. We have gathered a speaker to provide estate planning counsel and fiduciary advisors with an advanced practical guide to basis adjustment techniques and strategies to minimize income tax on estate and trust assets. The speaker will discuss advanced strategies for achieving income tax basis step-ups under various client scenarios, including spousal and non-spousal trust beneficiaries. Our speaker today is Jim G. Blaze, adjunct professor at Villanova University School of Law and principal at Blaze & Associates, LLC, St. Louis, Missouri. Jim, when you're ready, we'll get started.
Okay, thank you, Sandra. Welcome to everyone from hot and steamy St. Louis. We're going to have to cover a lot of material in a short period of time, so not a lot of time for jokes today, unfortunately, but maybe at the end we can have a few if we get through it all. I want to let you know that what this presentation really is, it's derived from a portion of my book. My book is called Optimum Estate Planning, and it's available on Amazon, and I priced the book at the very minimum price that Amazon allows. I think it's like $12 a book. So you can, if you want to read more on any of this, you can read on it. But the book is called Optimum Estate Planning. It's because of my strong belief that at least 95% of our cases, if not more, clients would, but for the income tax consequences, want to use trusts for a variety of reasons that we all know and we'll discuss here. But because of the various things that Congress and the IRS does to our clients, sometimes they're counseled not to use trusts in order to minimize income taxes. So what we want is we want our cake and eat it too. We want all the benefits of trust with none of the IRS negatives on the income tax standpoint. So today we're going to be talking about one element of that, and that is to how to ensure that we get income tax basis step up as each interest in a trust terminates. The other major parts of the book are how to minimize. Everyone, again, on this line is familiar with the high income tax, the abusively high income tax rates on trust. The part of the book discusses how to avoid that high tax, or how to eliminate that high tax, again, though, without destroying the purpose of the trust. It's easy, for example, to avoid high income tax rates on trust if you just distribute all the income out. But when you talk to the clients, but that's not what we want to do. So how can you avoid the income tax without having to pay all the income tax income out of the trust? The second part deals with, again, 95+% of our clients fall into the situation where when they're at or near retirement, the vast majority of their estates is in their qualified plan or IRA, and we all know about the various rules for paying those benefits to a trust. What is promoted often is the concept of a conduit trust. Again, this is not a course on conduit trust, but I can tell you right off the bat that I've never used a conduit trust in my entire career. And the reason is because you can do it better. If you think about, if you know much about what a conduit trust is, it says as every IRA payment comes into the trust, it must be turned over to the beneficiary, which in English means if the beneficiary lives to life expectancy, every penny of that IRA or 401k is going to be in the beneficiary's bank account. And that defeats all of the reasons we have trusts. So the second part of the book explains how you can, again, get what's called stretch IRA treatment without having to pay all the conduit amounts out. And then also, again, by doing part one, which we just discussed, why eliminating or minimizing the high income tax rates on trusts. So those are the other two elements of the book. And if we're lucky enough to get done early enough to this afternoon, I'm going to talk about those more in detail. So again, we all know this. Everyone on this line already knows this. Why do we use trust in estate planning? Because if all we cared about was income tax basis, we would just distribute everything outright to the spouse and to the next generation. But what we do in estate planning, the reason clients pay us is that because they are concerned about more than just income tax basis step up. So these are just some of the examples that we're all familiar with, on this conference call: death tax protection, and then especially estate taxes. And I'm going to refer to an article I wrote earlier this year that emphasizes more the need to be concerned about state estate taxes and inheritance taxes, because we have these in like 15 states now. And the problem is that most of the time, and not most of the time, almost all the time, the exemptions in those states are much lower than the new $11 million exemption and even the $5.5 million exemption, which we may have back in year 2026. So this article discusses how to focus on that and be sure you don't fall into that trap of avoiding federal tax but causing state taxes. The other things we all know about are lawsuit protection. Trusts protect our clients, whether it's our spouse or children, from lawsuits and creditors. We have minor children where we basically have to use a trust when we have minor children, but we also have older children that have issues that we may want to protect them also. Again, we all have these issues. We're concerned, our clients are almost always concerned about potential divorce of their spouses, and so they want to, and even remarriage. So they want to be sure that these trust assets are protected if a spouse gets divorced and or remarried. Of course, when you have a special needs situation, you have to use a trust. There's no option on that. So that's great, but that's probably the best example. If we have special needs trust, is there a way to avoid the high income tax rate on our special needs child? Again, the Optimum Estate Planning book gets into that, how you do that without having to pay the income out to the child. And all the others. And, why should we be penalized? In other words, why should our special needs child be penalized by the mere fact that they have special needs? So we want to have basis increase. We want to protect our special needs child from lawsuits and potentially other predators. And then last but not least, certainly second marriage situations. You're probably all similar to me, that maybe up to a third of your clients are second marriage situations. Well, obviously you're not going to want to pay the assets outright to that spouse in that situation. At least most of the time you're not going to want to pay them outright and risk that spouse leaves the assets to his or her kids rather than to your kids. So all these needs for trust. And so our goal in estate planning is that how can we achieve all these goals, again, without all the penalties, the income tax penalties that the government and the IRS imposes. That's what this course is all about, and that's what the book's all about. My cursor is going pretty slow here. So for large estates, again, your larger clients, you're going to have to use, generally you want to equalize, like we're still doing that right now where we have larger clients, and it may have been in years past we said, well, all you really have to do is have $5.5 million in each trust, a husband and wife's trust, and you are avoiding estate tax. But now if you don't recommend to the clients that they shift gears on that and potentially have up to $11 million in each trust, you may be paying unnecessary estate tax at the second death. Most people, not most people, but often what you hear today is, well, why is that a big concern? We now have the spousal portability election. Well, again, we've, other than situations where we want to use the spousal portability because we want to take advantage of stretch IRAs, for example, and the special annuity rules when you pay outright. With situations where we almost have to pay the benefit outright to the spouse to get the maximum deferral. Other than those cases, we never rely on spousal portability, because why would you do that? If you can, as this course is going to teach, if you can achieve income tax basis step-up at the survivor's death, okay, and you can minimize the high income tax rates on those trusts, why would you want to rely on spousal portability election? Because, again, as all we all know here, spousal portability election may not be available if the surviving spouse remarries. It's not available to protect future growth in those assets. It's not available for generation skipping transfer tax purposes. It may not be available for state tax purposes. Most states don't have the portability election. And again, state tax may be the issue in the future. And probably one of the more important factors is relying on spousal portability eliminates asset protection for that trust. Just so you know, most of the credit shelter trusts, we have clients that are worth upwards of $1 billion, but we also have what we call grandma clients. And the thing I would say is that most of our credit shelter or bypass trusts have very little to do with the federal estate tax exemption. We're doing it for this reason right here, asset protection. And the second situation here, where we're the second marriage situation, where we don't want to pay outright because the spouse may leave it to his or her own children. So it's probably the last two where you really have about 80% of the situations where you want to use trust. It has nothing to do with federal estate taxes. And again, most of you, if you will, think about your clients. I'm sure your clients fall into a similar situation as Mars. So what I want to talk about first is probably the most common situation. With the high federal estate tax exemptions now, most of our trusts, well, we don't really think about this, but most of our trusts are really what we call zero inclusion ratio trusts, which means we can apply our generation skipping tax exemption to that trust when the decedent dies, and those trusts will be exempt from estate and generation skipping tax forever in most states that don't have a rule against perpetuity. So that's the vast bulk of our trusts, and that's the thrust of this course today. All the other material for higher net worth clients is in the Optimum Estate Planning book, although we're going to touch on it today. So again, most of these bypass trusts are going to be what we call zero inclusion ratio trusts. The only thing I would say is, as you all know, you have to be careful about state estate taxes. And not just state taxes necessarily on your client's estate, but what could happen to your children. I think we oftentimes forget that, for example, I practice out of Missouri. Well, we don't have an estate tax. But I could say that all day long, but I have absolutely no idea where my clients' children are going to be living when they die. And, as we know, most of the jobs are in New York, New Jersey, Massachusetts, Illinois. These states all have estate taxes. And so we have to remember that in our planning, that just because our clients don't live there, our clients' children may live there, and even though they don't live there right now, doesn't mean they're not going to live there when they die. And so you kind of get the clients thinking about that, and they start thinking, I guess that makes sense. It easily could happen that at least one of my child ends up living in a state that has an estate tax. But the main point I'm trying to emphasize here in the large majority of the cases is that most of the time our clients' children are not going to be subject to estate tax. They're not going to have large enough estates to be subject to estate tax when they die. So if you think about it, and the spouse probably won't either. So if you think about it, if we set up a trust for that person, and as everyone knows, the general rule is that these zero inclusion ratio trusts receive no income tax basis step up when the beneficiary, the spouse, or the other beneficiary dies. When you think about that, you go, well, that doesn't make a lot of sense, because my child may die with a $2 million estate, and there's a $5.5 million federal estate tax exemption, and the trust is worth, let's just say, $3.5 million. So we have this trust, $3.5 million when the child dies. So we have this trust worth $3.5 million. Those assets are going to pass on down to grandkids someday at a carryover income tax basis. Whereas had they been included in the child's estate, that would have been $3.5 million plus $2 million. That's $5.5 million. The estate tax exemption is $5.5 million. So therefore, there's no estate tax, but we achieve full income tax basis step up. So that's the general concept what we're dealing with. Again, that's most of the situations you're going to have out there. Most of the time, your children are not going to be subject to estate tax, and we're kind of wasting. We like all these benefits of asset protection, divorce protection, et cetera, but we're kind of wasting basis. And so that's what this course is all about. How can we, again, have optimum estate planning where we have all the protections, but we don't lose basis step up? Generally, the way this is done, there are some options we're going to discuss, but what we're going to discuss today mostly is including in what we call conditional testamentary general power of appointment. And I think to this point, at least most of you have been exposed to that a little bit. I've been doing it for years and writing on it for years. I just wrote the book last year, but I've been writing on this subject for years. And we're going to, what I want to do today is not only go over the theory behind what this is, how this works, but we're going to actually go over every single sentence of our forms. And that's coming up in the slides that I follow. We're going to go over every single sentence. Why is it there? What does it mean? Are there any options to it? Because my view is, if you don't have the, if you're a smart estate planning attorney, if you don't know the reasoning fully comprehend the reasoning behind every sentence of a proposed form, you're not going to use it. I mean, if you're a good attorney, you're not going to use it. You're not just going to blindly put something in if you don't fully understand it. So that's my view, is that the best way to achieve that level of knowledge is to go over every sentence, and that's what I'm going to make you do today. Okay. So again, the obvious example we're talking about here is, let's assume a $5.5 million estate tax exemption and no state estate tax. The beneficiary dies with a $3 million estate. Again, there's room for $2.5 million of assets to be included in that beneficiary's estate, and without paying any estate tax, yet getting basis step up of that, and that's under Section 1014 of the code, and we'll go into that a little bit more. Okay, so that's generally what we do. We don't have, though, the automatic inclusion, at least our forms don't have it, if the beneficiary is survived by a spouse. And the reason for that is that although it's nice to get basis step up, what we have to be leery of is federal estate taxes. Because if the beneficiary, let's just say the beneficiary, your child, is survived by a spouse, and the spouse is worth $20 million. Okay, and let's just say your child has a zero estate, has no assets, but the trust is worth, let's just say, $10 million. Okay, so we could, depending upon what the exemption is when the child dies, we could potentially include assets in that child's estate, let's say up to $5.5 million, and get basis step up on that. But what you've done then is that you've then reduced the portability amount by that $5.5 million, and so that $5.5 million will not be available for the surviving spouse to apply against his or her $20 million estate, let's say. And so what did you just do? You caused an additional $2 million of estate tax at the survivor's death. Now, I'm not saying we don't necessarily want to do that, but what I'm saying is to automatically have this inclusion in the beneficiary estate in order to cause basis step up could really backfire on us. So the way we draft, we don't do that, and instead we give an independent trustee, either under the trust document or appointed by the trustee, an independent trustee, the ability to include in a conditional general power of appointment. Again, we're going to get into that more, and also to remove it, again, depending upon all the facts. So that's how we do it. You don't necessarily have to do it the same way, but I'm just really leery about having an automatic situation where we create basis step up, but we cause 40% estate tax as the cost of that, and most people say that's not worth that trade-off, especially when capital gains are optional and the estate tax is mandatory. Again, though, that's just our personal view on that situation. You don't have to agree with that. It's possible that a beneficiary could have more than one trust set up for them, and it could be several, but a common situation is you might have one trust set up for your child under an ILET or an insurance trust, and one set up under your irrevocable trust, and they both have this clause in it. So if they both have a clause that says we're going to intentionally include assets in the beneficiary's estate as long as it doesn't cause estate tax, the problem with that is that how do you read that if the person has two of those powers? So you need to coordinate the trust document, which also automatically coordinates, and we're going to go over that form in a second, but it automatically coordinates if there's more than one of these powers to be sure that, again, the beneficiary doesn't have a taxable estate as a result of it. Again, we're going to get into the form and show you our suggested language on that. Another thing that, in the example I just gave, when you have a situation where a beneficiary, let's say the beneficiary has a $3 million estate, and there's $6 million in this trust, and again, let's assume a $5.5 million exemption. So you're saying there's $6 million in it, but we can only include $2.5 million in, because otherwise the beneficiary's estate would be more than the $5.5. So the question is, how do we do that? Is it possible for us to pick and choose the assets out of that trust to include, so we include the most appreciated assets first? In other words, we include the stocks but not the bonds, because that way we still won't have any estate tax, but we wiped out as much as possible of all the gain inside the trust. And the answer to that is yes, and this is right out of the Section 2041 regulations. Again, all this is explained more in my book, and all the sites are in my book, but it's right out of the regulations. You can pick and choose, and then the question is, how do you do that? And we have basically a formula and we're going to go over in a minute how we pick and choose. Which assets do we do? And because it's very difficult, but you can develop, all these things you can develop a formula. And that was I always say this is the whole reason we took math class in school. We got to use our math skills some way, and this is why you develop these formulas that you learned back in high school. Another thing too, it's always possible though that you can have an asset that depreciated in value. So it may have been, the asset may have been it may have a basis of $100 in it, but maybe it's gone down in value to $50. Do we want to include that asset in the decedent's estate. Wouldn't that really be, we talk about basis step up, but wouldn't that be a basis step down? And the answer is yes, it would be. So we just eliminate that in our formula language. We say it doesn't apply to any asset that's gone down in value. And the key again to all this is the regulations under Section 2041 that permit this. You can have partial inclusions under Section 2041. So we're just taking advantage of the IRS regulations on that. I don't know if everyone remembers, but a few years back, President Obama was proposing an automatic gain. His views were basically almost completely different than Trump's views, and his views were that you're going to get a very small basis increase, like I can't remember exactly the number, it was around 200 grand, and after that you were deemed to have sold everything you own when you died. Everything that's includable in your estate, you were deemed to have sold it, and you paid income tax on it. Now, that's not the law now, but you never know, it could be in the future. So I think you need to draft your formula so that if that ever happens, then the inclusion on those assets does not apply. Because again, we'd rather have carryover basis than automatic gain. We'd rather have carryover basis and sell the assets over time when we want to with the best tax strategy rather than automatically paying tax, which is, by the way, similar to the current Canadian system. So that's got to be built in the forms, at least I think, because anything that's been proposed out there, and obviously you guys all have language in your trust document that gives an independent trustee the ability to make changes to the trust document to produce tax benefits. But the problem with that is that it's nice to have that language in there, but how are you going to get this actually done? You're going to go back to all your 2,000 or 3,000 clients and have them make this change. It's going to be very difficult to keep track of. So as much as you can, you want to put formula language in. And people complain. Some people complain that, oh, your forms are so complicated. And when I mentioned that to to clients, they kind of laughed. So I said, okay, so the alternative is let's just give the IRS the money because it's going to be the trust document is going to be 2 pages longer and it's going to be more complicated. So let's just give the IRS the money. No, what you want to do is your clients are all very bright people. You want to explain all this to them, and then you they can follow this general concepts, and then you send them a very good summary letter that explains all this in English. And then when you meet to sign later on, you go over it some more and you answer their questions, and you don't nickel and dime them by billing them every minute that you talk to them about this stuff. And if you do that, you'll have done a really good thing for your clients. And when I say clients, I always say it's really not, the people that are meeting with you are not the clients, it's their children. They're just really the advocates for their children. Yeah, I think that this is another important point, too, that it's hard to grasp this, but we do have this in our forms, and we're going to go over it, and that is that when we're talking about conditional power of appointments, we're generally talking about, again, most of you are familiar with this, a power to appoint the creditors of the beneficiary's estate. So that gets you a inclusion under Section 2041, and then as a result, under Section 1014 of the Code, that gets you basis increase. The problem is that may not be the law in the future. And again, for the reasons I just mentioned in the other situation, I think because we can see that potentially happening, either they eliminate the mere power to appoint the creditors as causing basis increase, and or they eliminate the estate tax. You have to build something into your documents that if that ever happens, we're going to go a different route in order to get basis increase. And basically, we're going to give the beneficiary the power to appoint to their estate if that ever happens. And then also, if you ever look at 1014 closely and you compare 1014 B4 to B9, you'll see that one talks about the existence of general power of appointment, the other talks to the estate, and the other talks about an actual exercise of the power. And so we could end up with one or not the other. And so this is you just kind of build this in. Again, I'm not saying it's complicated. Our clients are encouraged not to read all this type of language, but it is in there. And so just in case this ever happens, you've got it covered, and you don't have to go back and change a couple thousand estate plans. And again, it's pretty technical. You really need to read the book. It's discussed in the book, and you need to read those code sections and study them. Aside from this formula approach, which is what we primarily use, I know a lot of lawyers use this other approach, and there's nothing wrong with it either, and that is that if you're familiar, again, with 2041A3 of the code, it's called the Delaware tax trap. I don't like that term. I'm just using it here because some people, when I say that, they know what I'm talking about. But basically, 2041A3 says if you give a beneficiary a power of appointment, and then that beneficiary actually exercise that power of appointment by creating another power of appointment, which is not exercisable by reference to the creation date of the first power, so it's rather technical. But if you do that, and the beneficiary does that, then to that extent, the beneficiary is going to will have those assets included in his or her estate, and therefore get basis step up. So again, this is a portion rule too. It doesn't have to be all or nothing. So we've done this several times where we've had existing. We're going to go over this in a second, but we've had existing situations, and we've had the beneficiary exercise these powers by violating the rule. I've heard some people say, well, you can't do that in states that have a rule against perpetuities or this or that. It's not true, because all you have to do is, it says all you have to do is don't refer to the creation date. So you might say, I'm just making this up, that the trust terminates 1,000 years after after June 20th, 2018. Well, June 20, 2018 has nothing to do with any date. It's definitely not the creation date of the trust. So you've referenced a date that has nothing to do with the creation date, and therefore you violate Section 2041A3 of the code, and you cause inclusion, state tax inclusion, to that extent. So I know we went over that kind of quickly, but I want to make sure people know that if you want to go this route, again, the reason I don't like this route is that the difficulty is anything that requires action of someone after they've left your office, I don't like. So if you have, like, for example, I'm not a fan of disclaimers. Anything that's going to has to involve action of other people, and you may not even be practicing or whatever. If you have to do it, fine. But if you can avoid it by having a formula, just automatically the perfect thing happens. Why wouldn't you do that? Why would you? So this is more, in my view. You can plan this way, but to me, this is more what you do if you have an existing trust. What can I do with an existing one? I wouldn't personally use this approach for planning purposes, but you can, and people do. I'm just making sure people are aware of it. Okay. There may be certain situations where you can't even do it, by the way, depending upon the way that trust document is drafted in state law. Now I'm going to go over this form. So again, this is, there are other forms in the book. This is just the form for credit shelter trust that we use. Okay, again, I'm going to go over a sentence. There's like 9 parts to this form. And so I'm going to kind of exhaust you here, but I think if you can follow along at all, this will give you a feel for why everything is in there, why we just discussed everything we just did. So it begins with, when it says, in addition, what this means is, after you give the person a standard limit, if you want to give the client, the beneficiary, a limited power of appointment, and again, in this example, this is our credit shelter trust, so we're talking about the surviving spouse. So the surviving spouse has a standard limited power of appointment to descendants or charities or whatever you want to include in it. Then you have this additional language. This comes in there, and now we're talking about the conditional general power of appointment. Okay, so one of the things we say right off the bat, and I'm sure you guys say this too, in all your powers of appointment, you say the power of appointment applies unless assets have passed to the trust as a result of a disclaimer. And the reason for that is, you know, that you can't have a qualified disclaimer 2518 if the decedent has a power of appointment. It can direct where those assets go. So we don't have this clause in there. Again, we rarely have assets passing to a trust as a disclaimer, but if you use that technique a lot, you may have to reconsider it, because it's going to be hard to have both a power of appointment and a disclaimer in a bypass trust. So unless assets have passed via disclaimer, okay, or then we say with these exceptions here, it says except as provided in these sections. What these sections are they're dealing with, number one, remember I mentioned we have special language for IRAs and 401ks payable to a trust. So that's in there. And the reason for that, again, if you're familiar all with how this works, you got to be careful about giving a person a testimony power of appointment to creditors of the estate, because that could stretch IRA. So there's language in our forms about that. That's in the back. And then also we have to comply with the second blank there is for what we call our anti-2041A3 protection. And all that means is that the way our trusts are drafted, it's impossible to violate that Delaware tax trap unless you definitely say you want to. You basically got to say, I definitely want to violate it, and that's what the second clause says. So you can't have an inadvertent violation. I think it's important to have that kind of language in your forms. Okay. So again, then you say the next sentence: if the surviving spouse is not survived by another surviving spouse. Again, the reason is for that we just talked about. You may want to use portability, so we don't have the automatic language. Okay, in that situation. And finally, at the end of this first introductory clause, okay, we're going to have this general power of appointment to appoint the creditors to the extent that it will not result. So again, this is the key clause at the very end. To the extent the power of appointment will not result in four different things, and we've already gone over those. But the first one is the surviving spouse of the estate being liable for any federal or state estate or inheritance tax. Okay, so this only applies to the extent. It won't cause estate taxes. Now, one thing I think is very important to see the parenthetical there. It says, assuming no alternate valuation date or similar elections, qualified disclaimers, or deductible administration expenses. What's common to all of those is these are things that are all discretionary after the death of the spouse. Whether someone makes an alternate valuation date, is up to the executor, and qualified disclaimer is the same. Whether you deduct administration expenses on the estate or versus, all those things we don't know the answer to that. But for 2041 purposes, we have to have an exact number. You can't have 2041 over some number that's going to be determined by somebody else in the future. No, you have to have a real value. So we just assume none of that takes place. So it may not turn out perfectly, mathematically it may not turn out perfectly, but at least we have certainty that our conditional power of appointment is going to work. Again, the other exception is the surviving spouse. We haven't talked about this one yet, but the surviving spouse not being liable to reimburse any government agency for benefits. So if for some reason the surviving spouse was on Medicaid, for example, we don't want this power of appointment to exist if it's going to cause the trust to have to pay, say, $1 million to the state, because again, we're saying the same thing. We'd rather have carryover basis than pay out $1 million. Okay, that's basically, so you don't have the power of appointment if it's going to cause a reimbursement to the state. And then finally, we already mentioned about the surviving spouse's estate or the trust being automatically subject to income tax. We don't want that either. Okay, and then there's one more exception here. And we talked about this to the extent that it results in a reduction of income tax basis. We don't want that either. So those are all the caveats we've built in. Again, you can look at it and say, boy, that's really complicated, Jim. And my view would be, okay, don't do it. Just give all the money to the IRS. That's your choice. So use the language or use your own version of the language and then do a good summary letter that explains it all in English to the client. And it was interesting. We had a client come in the other day, and I thought the perception of this client was just outstanding. He said, I listened, I attended your meeting. It was really good. I read your summary letter that explained it really good, and it really helped me kind of read the document. And then after that, there was an element of trust. I said, you're exactly right. That's the way it works. It's just kind of like when you meet with your doctor. You explain it the best you can, but after that, you just got to have an element of trust. And if you don't have that, then we've never had that situation. But I mean, how can you do estate planning without just giving the IRS all the money without an element of trust? Because you're going to have cites in your trust document to Internal Revenue Code sections, and by definition, the client doesn't know what those sections are. And so there's going to have to be an element of trust. So then you see that now we say, okay, we're going to have this power of appointment, power to appoint the creditors of the decedent's estate, but we're going to begin with the asset or assets having the greatest amount of built-in appreciation. And then we have a little parenthetical as to how you calculate that, okay? And I'm not going to spend a lot of time today, but basically it's not based upon which asset has the most appreciation. It's which assets have the most appreciation as a percentage of value. So in other words, you can have an asset that's $1 million appreciated, but really, as a percentage of value, it's only 10% appreciated. But you could have another $1 million of assets that have almost 100% appreciation when added together. So that's how you do it. You're trying to figure out where we want to get the most appreciation included in this general power of appointment, not the particular asset that might have the greatest appreciation, but instead the greatest percentage of appreciation. So again, we mentioned this. Normally the power is to appoint to the creditors of the surviving spouse's estate here, but here's this parenthetical I mentioned earlier. I said, or to the surviving spouse's estate and any one or more individuals and or entities, including a trust or trust, if the power to distribute such assets to the creditors of the surviving spouse's estate is not sufficient to cause a federal income tax basis adjustment under Section 1014. Okay. Now you say, well, why is all this other stuff about the ability, the power to appoint to a trust? Well, the reason that's in there too is that let's say that the law is changed and it's more of the 1014B4, I think it is, language that says you have to actually exercise the power. Well, we don't want to exercise the power to the estate, but we had the ability to appoint to the estate among other people, so that's enough to get inclusion. But when we exercise it, we want to exercise it to a trust because we don't want probate. We don't want probate administration. So that's why that's in there. You have the power to appoint the estate, but you can appoint to other people too. And that's why we want to make it really clear. This other language is the bold language. That's kind of the way we do our forms. We put in little warnings in there to ourselves that, like in this example, you may not want this real broad power to appoint to anyone you want to. If it's a second marriage situation, for obvious reasons, a spouse could appoint to his or her own kids. And so that's, again, you can't miss the forest for the trees. Sometimes you just don't want that language in there. So we might just include the power to appoint to creditors, and that would be it, and creditors of the estate, and that would be it, and then take our chances that the spouse is going to run up millions of dollars of creditors just to be able to, and then obviously that would be, let's say the spouse says, I'm going to make my children the creditors. Obviously that would be fraud, and that would be not honored by a court. I'm not really too worried about stuff like that. And then finally, when it says at the very end, using the same appointment procedure described above, that's talking about whatever appointment procedure you have in your documents for limited powers of appointment, like, for example, you have to appoint by a will, whatever it is, we use that same appointment procedure for a power to appoint to creditors. Some of the other provisos that we've been talking about, this one, a lot of you use documents that you end up doing a qualified severance. So you take a trust and you divide it into two shares. One may be GST exempt, one may not. This is just saying if you do that, let's apply it to the one that is not GST exempt first, because that's the one that we're saying that's going to eventually have tax on it anyway, or it might have tax on it anyway. So if we're going to have a power of appointment, let's apply it to there first, and then to the extent that it's not already, you may already have a general power of appointment because there might have been a skip at that point. And in any event, under your own forms, you may or may not have an automatic general power of appointment. This is saying, to the extent there isn't one, but there's still an inclusion ratio other than zero, let's apply it there first, because that's the smartest way to do it, because there will eventually be tax on that anyway. And then after that's all used up, then we'll apply it to the trust that has an inclusion ratio of zero. And again, that's just drafting. Everyone uses a different style on that. We've already talked about the fact that what if the beneficiaries, the spouse in this example, is a beneficiary of more than one trust? We want to make it really clear. This is why I start off right away. I say, under no circumstance shall the surviving spouse's estate be liable for any federal estate or inheritance tax as a consequence of the surviving spouse's foregoing additional power of appointment. And if necessary, what we do is we basically apportion it. The power of appointment will be apportioned so that, I'm just making this up, if the ceiling was $3 million before we caused estate tax, and the one trust is worth twice as much as the other, the way this would work is there'd be a $2 million power of appointment over the larger trust and a $1 million over the smaller one. Still possible, though. What we're trying to say is, hey, we want to make this crystal clear. And under any possible reading of this language, or it may be that the other trust is drafted differently than your trust, we're saying, hey, if we have to use a greater amount, allocate a greater amount, we're going to. So in other words, we're going to make sure, okay, that we're not going to have estate tax. So we say, that's what we say about or by a greater amount. Under no circumstances will spouses pay any estate taxes. And if we have to go beyond this and basically almost eliminate the power, then we're going to do that. We don't want any ambiguity. We're not going to pay 40% estate tax. That's what I'm saying. It's not worth the basis issue. Should be on part 7 here. Here we go. We talked earlier about the exception if the surviving spouse or beneficiary child is survived by a surviving spouse, we generally don't want automatic basis, at least in my opinion, you don't want automatic inclusion, even though it won't cause any estate tax, because it could be that you're better off not doing that and then having a much larger spousal portability amount available for the new surviving spouse and wipe out a 40% estate tax at that surviving spouse's estate. It may be that the client said we'd rather have that than get basis step up. I'm not saying automatically, but you can see the issue. So I would not automatically do it in a spousal portability environment. That's all that's about. But I think it needs to be in there, especially with so many people. Second marriage is not necessarily a divorce, but just remarriage later on in life. And we also talked about if we have a situation where we have these automatic, on this, I'm on part 8 now, it says, not to possess the power of appointment to direct, if the surviving spouse appointed the trustee who or which it possesses the power of appointment, and that itself causes an issue. In other words, if under the law, even though an independent trustee is the person that's calling the shots here, if the surviving spouse appointed that independent trustee, and someday it's interpreted in the law that, hey, if you appoint the independent trustee, then we're going to deem it as though you did all the stuff that is not in the law right now, but if it ever became the law, then we're saying we got to be careful about that, because then you're deemed to have the power, and that's a pretty broad power. You're basically deemed, in other words, it's going to basically cause the inclusion, and you're not going to have the portability election available, because the IRS would argue you're deemed to have the power because you had the power. That's enough under 2041 to have the inclusion, so you won't have portability. So we just throw that in, that if that ever happened, then we're not going to do it. Again, we don't want to automatically eliminate portability because of the 40% rate. And then finally, this is just instructions to that independent trustee. The independent trustees want to have some guidance. So, should we exercise this power or not? And so this is just some guidance we throw in there about what you're supposed to look at, independent trustee, in deciding whether or not you want to bestow a power to appoint to creditors on the surviving spouse. These are the issues you look at, and basically telling you, what we want you to do is minimize taxes. That's what we want you to do, because otherwise they'll say we're afraid to do it, we might get sued, et cetera, et cetera. So this is how we handle that. Try to give them some guidance as to what they're supposed to look at. And again, it's generally, we want you to minimize taxes to my family. Now, you notice that all we've really been talking about today is trusts that have a zero inclusion ratio. When you get into trusts that are potentially subject to generation skipping tax, you get a whole other set of issues, and it's kind of beyond the scope of today's presentation. But I wanted to mention it, and I give you this link here to an article I wrote earlier in the year. And what this is all about is saying we might want powers of appointment, et cetera, but what we're focusing on in this situation is not so much basis step up, but we're focusing on what strategy is going to minimize our overall federal and state, estate and generation skipping transfer taxes. Okay, and so if you read this article, you see we develop a formula on that, and it can be done. So I'll just give an example. We had one recently where the client is in Illinois. Well, Illinois has an estate tax, but they have some people say they have no generation skipping tax. I think they actually do have a 2% rate, and the article gets into that. But I'm saying that, but right away you're saying, okay, well, do we really want inclusion in that situation? Because if we didn't have inclusion in the beneficiary's estate, we'll have federal generation skipping tax at 40%, but that's basically all we'll have. If we have inclusion, we might have both Illinois estate tax and federal estate tax, and Illinois estate tax can be upwards of 15%. So we might have a 55% tax rate on that, and we would have only had 40, or at most 42%. So what you need to do, I think, in your trust documents is that in these trusts that have an inclusion ratio of under 0, I think what you need to do now is you need to develop some kind of a formula that's whatever it's going to take to minimize the overall transfer tax liability, federal and state. And again, think back to what I just said. You have no idea where those kids are going to be living, your client's children are going to be living when they die. You have no idea. And they could be in a state that, I think some estate tax exemptions are as small as like $2.5 million now, versus $11 million. So you got to be, all I'm trying to say in this article is you got to be really careful about that. And there's a lot of surprising rules out there. Like it's just that state laws may be totally different than federal concepts. Like Illinois is a good example where they basically have no or very little generation skipping tax, and yet they have a state tax, a big estate tax. Okay, so the article gets into all that, and we'll and let me know. I have my email, and if you have any questions about that article, it should be available at that link. And then we'll kind of move quickly. This is the thrust of what I wanted to talk about today. We've just covered. Now I'm going to talk about all these other miscellaneous issues that can come up, so you'll have some background on it. We'll move a little bit quicker. But we mentioned earlier, you can have, what if I have existing trusts out there? What can I do? Well, there's a lot of options out there, and we're all familiar with them. I'm just kind of highlighting some things we see. But one of the options is using decanting trust legislation. I think the main thing on that is that you got to be sure that what you do, you can't just create a new trust. And again, this is not a seminar on decanting trust, but the general concept is if your state permits it, you can set up a new trust, and the trustee can transfer the assets to the new trust. The major issue is be sure what you're doing is authorized under the statute and the trust document. You can't just do it, and every state's different. Okay. For example, Missouri has a clause that says, well, you have to act, and you still have to act in a fiduciary capacity. Well, what does that mean? I'm not exactly sure, but I'm sure that one thing it means is you can't just cut somebody out, as a beneficiary. Pointing to creditors of the beneficiary's estate, that's arguably an issue, but I think most people would say that I think a fiduciary, knowing that there's really not going to be any creditors or very small, and regardless in the overall grand scheme of things, it's going to really increase the amount available left for the remainderman, might say that is acting in a fiduciary capacity. I'll take that risk because I think the risk is very small versus the reward. See that? So it's mainly looking at your statute. They're all different, and is it permitted? And you just got to study it. And we generally try to be pretty conservative on that, unless the client's willing to take the risk on what the statute says. Our statute is not well drafted in Missouri. I can tell you that right now. There's almost every sentence is ambiguous. And again, I mentioned about it may be a fiduciary duty. You got to make a determination. They may even need a legal opinion. Is this acting within fiduciary duty? But again, the major point is look at your trust document, look at your statute. Is what you proposing permitted? And it may or may not be. And sometimes you may just want to take the chance on it. The IRS has issued a notice that they have all these issues with decanting, and we're going to get into that in a second. But there's all those kind of issues too. Your trust document may have a trust protector clause in it, which may permit this. Like I mentioned, we have one of those in there. That's probably the best way to go. If the document has a clause in there, then you just got to make sure is what you're doing within the purview of the trust protector clause. There's states have trust modification statutes. Some with and some without court order. Take a look at those, but that's not the end, because the end is this issue I mentioned. But it's not just the IRS notice on this; it's just kind of common sense that when you do these things, there's potential transfer tax issues. Like most of you are familiar, if you have a grandfathered generation skipping tax trust, what you do here could be what's called a substantial modification, and you may make the whole trust subject to generation skipping tax. So at a minimum, you want to have some kind of a safe harbor clause in your document that says, to the extent we're violating these sections of the regs, and this change is void. At a minimum, do something like that. The gift tax issue is more that if there's a serious question whether what you're doing is permitted, but you go on and you have everyone sign off on it and they consent to it, including all the remaindermen and the life beneficiaries, you got to think about that a little bit. Well, why are you having them consent? If it's so clear it's permitted, why are you having them consent? So you're really saying it's not crystal clear, and because you're having them consent to something, they may be making a gift. Because if they have the ability to argue that what you're doing is invalid and you're potentially harming them, there may be a gift there. So most of it's just common sense. I do think, though, that what I have found is if you take the time, you can usually navigate all these issues just by using common sense and applying general state and gift tax principles. I mentioned earlier about sometimes with an existing trust, if there's a limited power of appointment in the trust, you may be able to intentionally violate Section 2041A3 in whole or in part and cause inclusion and therefore get basis step up. And basically, you use all the language you just said. You said, well, I'm gonna violate it, and here's how I'm gonna violate it with the, for example, the most appreciated assets first, et cetera, et cetera, et cetera. I'm only gonna violate it to the extent there's no estate tax on my estate. All those types of things. And the main thing I'm gonna say there is the whole key is that you have to violate it by allowing or establishing another power of appointment, which can be exercised not by not referring to the creation date of the first power. And that's really pretty easy to do, and I think, because you just refer to a different date. Okay, and you say, well, this is the date I'm using, and I think that once you do that, then you violated it, because that's not the creation date. By the way, there's a huge issue as to what is the creation date of the first power, especially when you have a trust set up under a revocable trust. Is it the date you set up the revocable trust? Is it the date you amended it to include this power? Is it the date of death of the grantor? In my opinion, that is not crystal clear at all. So we don't even try to define it. We say basically that whatever the creation date is, because we don't know what the creation date is. Okay. Finally, this is why I put this at the very end. Finally, if everything else fails, you can always distribute assets outright. So you can encroach, or you can go under a trust statute to terminate the trust or whatever. But my only point about that is that's not the first option. At least in my opinion, that's not your first option for getting basis on an existing trust. That's your last option. And so, you may even want to, let's say there's a lifetime power of appointment, instead of just appointing the assets outright to the beneficiary, why don't you appoint him to a trust for the beneficiary that has all this special language in it? So now you have your best of both worlds. You'll get the estate tax inclusion, but you still have asset protection, estate, et cetera, et cetera. So appointing assets outright are really kind of the last approach. It really only makes sense, in my opinion, where you're not talking about a very large estate. But that's just my own personal view. A few other things I want to touch on. These are all in the book. They're explained much more in detail in the book. But creating basis step up when a parent dies. What this is all about is, you have a situation where you have a large exemption right now, and so the parent may not be subject to, or even close to subject to, estate tax. Yet you're sitting on all these appreciated assets. Why not consider, putting those in a trust and giving the parent some kind of a conditional general power of appointment over it, and then have those assets come back to you in some form of a trust. And then what happens is, when you set up the trust, you made a taxable gift, but you have a large gift exemption, and then when the parent dies, the parent applies his or her generation skipping tax exemption to it, so it's not included back in your estate. But the benefit is, there's a lot of benefits, but one, you'll get basis step up on that. Two, those assets will now all be protected from lawsuits, or at least potentially protected from lawsuits. And in the book, it explains how you can solve all the income tax issues on the trust, et cetera, et cetera. So it's just something, and all growth in this. So those assets grow, your parents die, and you live another generation, and those assets doubled or tripled in value. All that growth is out of your estate. So definitely something to consider, called upstream basis planning. And the book explains that more, and some of these slides are a little more detail on that. But I almost spent a lot of time on it. But basically, that's the whole concept: is you're making a taxable gift. The parent, in turn, is applying his or her generation skipping tax exemption to that trust. And of course, you got to make sure, using formulas, that you won't cause any estate tax when the parent dies. So it may not be a power appointment over the whole trust. There's everyone's familiar with, there's the 1-year basis rule out there. So the way I draft them is that what you do is you say, this is an interesting thing that I don't think many people give some thought to, but you really should. So if you use this technique, you can say, well, I need to then draft that trust. What if my parent dies within a year? I need to be sure I draft that trust so that I'm getting as much, I'm avoiding the 1-year rule to the extent I can. We're going to get into that more in a second here, but the way you do that basically is you kind of eliminate you minimize your rights in the trust, your actual rights in it, and if you do that, you're going to get most of the basis step up. And I think that's important, and we'll get into that. But I think one thing you want to do is, if your parent lives more than a year after you set up that trust, you don't have this issue. So there ought to really be two articles for you, or two different versions of the article for you. One is, here's what happens if my dad dies within 1 year of my transferring assets to him, and here's what happens if he lives more than a year. and it's a totally different, it can be a totally different trust, and your powers can be much broader over if they live more than a year. And at this point, we're not talking about a terminally ill parent, just a parent in general. Okay. So again, we talked about all the benefits. You get asset protection, all appreciations out of your estate, a lot of good things off this in addition to basis step up. You may be concerned that the IRS will argue, well, this is a step transaction. This is all intended as one big step, and that's a potential argument out there. So what you do on that, in other words, you're giving the parent a general power, but you say, well, the IRS argues, well, there was never any intent that that parent would actually exercise it. Therefore, it's all fraud, and we're going to collapse it. I think one of the ways, if you're worried about that, is why don't you have the parent exercise some powers? Why don't you have the parent take some money out of that trust? Why don't you have, instead of just having the assets come back to you in trust when the parent dies just by default, why don't you have the parent actually exercise the power? Do different things, do a few things. So if you want to avoid the step transaction, have the parent take some meaningful activity on the trust, and I don't see how the step transaction can work. So again, parent can act. This is talking about the income tax rules on that. Again, I'm not going to spend a lot of time on that, but if the parent actually exercises the power of appointment, it's going to affect the your income tax reporting, because if the parent doesn't exercise the power, it's arguably just Section 677 of the code to you later on, and you're just taxing all the income, which most of the time is good, right? We want to be taxed on the income of the trust. We don't want the trust to pay the tax, but just making sure you know that. Whereas if the parent does exercise it, now you got the regular complex and simple trust rules applicable there. And again, without getting into this, it's all discussed in the book, but we avoid all the high tax rates on trust, primarily using Section 678 powers. That's mentioned at the end of the slide. So that's how the trust would be drafted, just so you know. We don't want, in other words, we don't want this trust set up and somehow you're penalized down the road for a generation on the income tax side because of all the high income tax rules on trust. So the book is saying, yeah, but that's easily avoided. One last thing, it's kind of technical, I don't want to spend a lot of time on it, but there's a difference under 1014 between having basis increase as a result of a general power of appointment and having basis increase as a result of the exercise of general power of appointment. Two different sections of the code, 1014B4 and 1014B9, and it's just saying if you just rely on B9, which is basically just the lapse of the power, you have a real estate that's been depreciated, you may end up having to some extent carry over income tax basis on that. So you may want to go the other route, the 1014B4 route, if you're dealing with appreciated real estate. I just want to mention that because once in a while you get that, and there's a way to deal with that. We're down to the last 15 minutes here, and I should be able to get through all these. This next topic is about obtaining income tax basis step up at the first spouse to die's death. So what we're really trying to do here, and you guys have read about this for years, all these different techniques. I'm just going to discuss the technique we use, which is not the same as what anyone else uses. So I just want to at least mention what we do. So what you're trying to do is you're saying, well, my client, my couple doesn't live in a community property state. That's an unfair rule that if a client lives in Texas or California, they get full basis step up on all the assets when the first spouse dies, but my clients don't get that. Is there any way we can do that? And what this technique basically involves, and again, I'm not even necessarily promoting it, but our job is to make sure we explain it's out there. The idea here is basically you set up a trust and you give both spouses total control over that trust. And by that I mean they can take everything out of, either one can take everything out of that trust and is not subject to any kind of rights in the other spouse. Okay, so obviously this isn't for everyone. But if you have a good marriage, 50-year marriage and this and that, and they're not worried about this issue, if you give them all that power, if you think about it, then when the first spouse dies, that trust is going to be included in that spouse's estate under a combination of 2036 and 2038 as to any assets that spouse transferred, but then Section 2041 as to any assets the other spouse transferred. Okay, so then what happens is when you die, first spouse dies, nothing happens actually. Nothing happens. The trust just goes on, and now the surviving spouse continues to have all that power, just like the spouse always had. The surviving spouse always had a power to take everything out of trust, and that just continues. And so in our opinion, that gets you basis step up, full basis step up under that combination of 2036, 2038, and 2041. And we feel like the 1014 one-year rule does not apply because if you actually compare this to all these more recent IRS private letter rulings, the facts aren't the same. In those situations, what happened was that half of a trust or whatever it was went somewhere else, whether it was to a family trust or whatever, went somewhere else when the first spouse dies. Here, nothing happens to it. And also under the regulations, this is why we always try to throw the regulations back at the IRS. As everyone knows, you set up a joint bank account, there's never any gift. So when a husband and wife set up a joint bank account, there's never any gift to the surviving spouse until the surviving spouse takes the assets out of the trust with no right of recourse in the other tenant, the other joint bank account holder. That's right out of the regulations and is in these slides here. So the point here is that's what we're doing here. There's never any gift at all by anyone. In this case, under the regulations, there's no gift. So therefore, how can the 1-year 1014E 1-year rule apply? Because that only applies to gifts within 1 year of death. There was no gift. Okay? And so that's what we're trying to, that's our best argument here is if you want to try to say, look, you got nothing to lose, I got huge gain here, and why is, by the way, why is avoiding gain at the first death so important? What's the big deal? Why don't we just wait till the survivor's death? What's the big deal? It's not just taxes. What I worry about, this is my own opinion, is what I worry about is long-term care, and that survivor, there's a very good chance that the surviving spouse is going to need long-term care someday. Well, in order to pay for that long-term care, how are you going to pay for it? Well, you're going to have to liquidate assets. Okay, if we can avoid capital gain when the surviving spouse has to liquidate assets to pay for long-term care, then what we've really done is provide more money for long-term care. And that's kind of the idea that we just want to minimize taxes, not just for the heck of it, but just, what's the reason for that? Why is it so important? They're both, 85 years old. What's the big deal? Well, it can be a big deal because, long-term care can go on for 10, 15 years, and you may need to start liquidating assets. We all see that. Okay, so again, my own personal view is that the 1014E is not violated because we never had a gift. Okay, and there is a old IRS private letter ruling, or I think it's a tech advice memo, which says this is the whole point about when you set up a bank account, there's no gift, and if either person can just revoke it all, there's no gift. So someone actually does it, okay, with no recourse in the other spouse. Well, that's not what's happening here. Okay, so that's the main point. There's no gift going on here. And so therefore, 1014E cannot apply. What I cite here, though, is, this is just another one of the private letter rulings about again, the situations that you've seen where, the IRS said 1014E applied. Yeah, but in those situations, there was the assets there was a gift because the assets eventually moved essentially from the surviving spouse to a bypass trust or to somewhere else. That's not what we're doing here. We're just doing this where the assets come back. Now, again, you wouldn't want to do this technique in a situation where, but we can't do this or you wouldn't want to do it in full because all these assets are going to be back in the survivor's estate. Maybe we have an estate tax liability. But with the larger exemptions out there, I'm just saying that in most cases, you're not going to have an estate tax liability, even if you just put everything in joint names, and so it might be worth doing it. So this is a whole discussion on, some people might argue, well, I thought 2040B of the code applies, so only half of the assets are included in the first spouse that dies estate, not all. This explains why the type of arrangement that we set up is not a 2040B qualified joint interest. It just explains all the reasoning behind that. And mainly because with a qualified joint interest, it has to be one of these where each spouse has rights in that in half. And this one, you don't, because the spouse has a right to take it all, and that's not a joint tenancy. Okay, if one spouse can just take all the money, that's not a joint tenancy under the law. And most people don't realize too that you say, well, the joint bank account says either spouse can take all the money. It does say that, but that doesn't affect the rights of the other spouse. Okay, that's just saying vis-a-vis the bank can give all the money to either spouse and they're not liable. But the other spouse still has rights in half that money that they can assert under state law. So it has nothing to do with the clauses we're familiar with, just has to do with how is the bank absolved from liability. So again, all this just gets into that discussion why I don't think this is a qualified joint interest, without spending too much time on that. This is the technical advice I mentioned from 1993 that almost the exact same facts that we're talking about here. And they said, what the IRS said in this tech advice memo, they said, in their opinion, what they're saying in English is, yeah, you are complying with all the letter of the law under this type of a technique, but we think that this isn't what Congress intended. Okay, they're saying they just didn't intend this, that you could get away with it this way. So even though you haven't made a gift, they're saying, yeah, but you fail another part of the test under 1014E, and that is the property must pass as a result of the death of the decedent or was acquired from the decedent. They're saying, well, no, it wasn't acquired from the decedent. It was just your money. So even though it's included in the decedent's estate, the decedent has a general power of appointment under it, and the general rule is always that's property passing from the decedent if it's includable in their estate. They're saying, yeah, I know all that, but this was not the intent behind 1014E. So I just want to make sure everyone knows that there's a private letter ruling out there, or tech advice memo, that says that we know everything you're saying, Jim Blaze, but we just don't think that was within the spirit. So you'd have to acknowledge that to your client, that authority is out there. Okay, I mentioned earlier that we have a bunch of other material in the book about what depending upon the size of the estate. If the client has a small estate, a medium-sized estate, or a large estate, how would you use this basis optimizing technique? And really beyond the scope of this program, but it's all in there, and it does depend upon how you use it, how much you put in the joint account, in other words, etc. How much you put in the separate shares for the husband and wife will depend upon the size of the estate, and then that may change over time as the exemption amount changes. Here we go. The risk associated with the joint share are pretty obvious. I mentioned right at the outset, you wouldn't do this with a newly married couple or someone that wasn't married a long time, or if there was second marriage, you just wouldn't do it with it because you don't want any risk associated. But I mean, if this is a couple been married 50 years and they have 3 or 4 kids, and I don't think that the risk is pretty dang small. What's the spouse going to do with the money? I mean, could give it to a new spouse, I guess, but the risk is very small, and even you can actually revoke it too, because the document says you can revoke your gift, so you can take your money back if you're ever worried about it. So I think you just got to look at the facts, and some kids, and then you got to protect yourself as the lawyer. And if there's any risk associated, say, here are all the risks. We've outlined these to you, so you're protected. But the way we do estate planning is we never tell a client what to do. I don't think I've ever told a client what to do. We just tell them all the risk, and they make the decision, and then they sign off that, yeah, we understood exactly what you said. It's a client's choice. It's not the lawyer's choice. Never the lawyer's choice, except for if you're doing something unethical or illegal, then it's the lawyer's choice. Another a risk associated with this joint share is, I already mentioned that you've basically severed a joint tenancy by doing this. You don't have a joint tenancy, and if you're in a state that has tenancy by entirety protection, and I think there's about 20 states now that have that, including Missouri and Florida, what you did was you just blew asset protection. So the client's got to sign off on that. They understand that we're no longer protected from lawsuits because we've severed our tenancy by entirety. Some states, I'm not really keeping track of these, to be honest, because we have one. Missouri has a statute that says you can do this and still protect it from lawsuits. Delaware has one, but I think there may be a trend in the future that more and more states are going to this, although I've seen some situations where the courts have struck these statutes down as against public policy, and that doesn't surprise me because it's nice that you're protecting our clients, our husband and wife clients, but what about all the creditors out there? is it fair to MasterCard or whoever, that you're striking these down? So, that's something that the clients have to understand, that, it may not be enforced for other reasons. Even though it's a statute, it may not be enforced based upon the court's law because of what you're doing. You're harming other people, namely the creditors, and that makes sense to me. So I can see that issue. So they have to know about that too. Okay, a lot of people just say, I understand all this, I'll just buy a lot of umbrella liability insurance. Okay, I'd rather have the tax benefit, and umbrella doesn't cost me much. Anyway, so estate planners have to be mindful of all these issues when they're doing their planning. And I think that one thing you have to be mindful of too, again, is, I've already mentioned this, is that estate taxes. So it may be because of the high federal exemption, hey, this may work great, just basically have most of the assets in a joint account, but your state estate tax may nail you on that. And that's why I mentioned the book gets into that situation, how you may just put the really highly appreciated assets in the joint share, and then you still use a husband share and a wife share for all the other assets. Couple more minutes here, and then we'll take some questions. I just want to, at the very close here, talk about basis planning with a terminally ill spouse. And so this is, again, a similar type of an issue where this is more transferring assets between spouses, but if one spouse is terminally ill, it's a very difficult discussion to have with the other spouse, and it may not be something you lead off with, but at some point, maybe you or discuss it with a family member, you may want to consider moving assets over to the terminally ill spouse so that the survivor will have basis step up again to be able to use for long-term care or whatever, or maybe just to keep the assets in a creditor protected trust or whatever your reasons would be. The big issue there is, again, aside from the obvious ones, is you're going to have the 1-year rule issue. And so what you want to do is draft that bypass trusted credit shelter trust. You want to draft that the best you can to avoid the 1-year rule. And this letter ruling that I cite here, private letter ruling 9026036, is probably your best roadmap. And what it makes clear is, I'm surprised there's not more law on this, but it is kind of clear if you look at the legislative history to 1014E and a 1-year rule, that it's not just if you transfer an asset to a person and they die within 1 year, and it comes back to you, you don't automatically lose basis step up. You only lose basis step up to the extent of your interest in that asset. So in other words, if the asset's transferred back to you outright, you'd lose it all. But if it's transferred back to you in trust, okay, now what you have to do is figure out, well, what's my interest in that trust? Because I only lose basis to the extent of my interest in that trust, and this is what that letter ruling discusses. So what you want to do then is minimize your interest in the trust, and there's a lot of ways to do it, by obviously putting other kids on as beneficiaries. Maybe you shouldn't even be the trustee of the trust. Definitely have the trustee be allowed to consider your other resources before. In other words, try to really minimize your interest in that trust. And to me, again, what do you got to lose? Because you're going to get a lot of basis step up, if not 100% basis step up. It's going to be protected from lawsuits and potentially protected from not only federal estate taxes but state taxes. So, we all get these in our practice, and so it's a difficult situation. But I think this is what you got to do. So again, the best you can, using discretionary powers, possibly not even having the spouse as the trustee, or at least having a co-trustee to minimize your interest in that trust. So again, this is just more examples of things you can do to minimize your interest in that trust. And I am about up here, and so I got 1 minute left here, and I'm going to open it up for questions and let moderator take over.
Thank you, Jim, for your insights today. And ladies and gentlemen, a brief announcement. New York State requires that you record and report the following code in order to obtain CLE credits for the live or recorded version of this CLE webinar. If you will be requesting CLE credits for this seminar, please write this code down. The code is TLEDAC. That's T like Tango, L like Lima, E like Echo, D like Delta, A like Alpha, C like Charlie. Again, that is TLEDAC. And now on to our live question and answer session. Listeners can ask our speaker any questions relevant to today's topic. You may email questions to estateplan@straffordpub.com. Again, estateplan@straffordpub.com. Or submit questions by typing your question into the Q&A box at the bottom left corner of the screen and clicking send. You may also ask questions by telephone. To do so, please press *1 on your touch-tone phone. Again, that's *1. If for any reason you decide not to ask your question, you can press *1 again to exit the question queue. After you press *1 and when it's your turn, the operator will announce the first name and city for the person registered for your location. If you'd like to identify yourself further, please do so. If you are asking a question by phone, please turn off the sound on your desktop. And our first question, Jim, I'm going to start with, there's a couple of questions regarding missing pages or slides. So that would be page or slide 26 and 41. And so I'm wondering if those blank slides were just placeholders that actually don't contain anything, or are those actually missing?
Well, I was told by you guys that those are placeholders.
Okay, perfect. Thank you very much. So that answers everyone's question that there actually aren't any slides missing at all. Okay, our first question. If there is a POA to Bean's creditors or the estate, doesn't that void the asset protection feature, or am I mixed up on this?
Well, number one, you can't possibly avoid your current creditors because you don't even have this power until you die. So any creditors you have while you're alive, okay, you will be able to definitely avoid those because they're not within the power of appointment. This is a testamentary power of appointment to the creditors of your estate. But yes, they could argue if you have a power, if you actually died and you had some bills, that they could go in there and say, try to make the argument, to the probate court that because you had a power to appoint to them, that therefore you should get it. Your executor's argument would be, well, you didn't do it though. And so therefore you're not a beneficiary because the decedent never did it, and they'll fight it out. But the main point is that while you're alive, that's the main thing, that your assets, the beneficiary or the spouse is totally protected because this right is not until you die.
Thank you. Does zero inclusion ratio mean an estate below the federal estate tax exemption? And do you not use an AB structure, credit shelter, because the estate is not large enough for federal estate tax?
Yeah, it does. It means exactly that. I mean, when I say zero inclusion ratio, any estate, if you die and your estate is under $5.5 million, every trust you set up will automatically have a zero inclusion ratio because the $5.5 million generation skipping exemption will be automatically applied to it. So for most of our, that's most of our clients today. That's what I mentioned at the beginning. Most of our clients, the trust they set up, have a zero inclusion ratio. If you have someone that's over 5.5 and they're married and they set up, so let's say they had $7 million and they put $5.5 million in their credit trust and they put $1.5 million in their marital trust, typically the $5.5 million trust will have a zero inclusion ratio and then 1.5 will have an inclusion ratio of 1. So the rules that we were talking about primarily today deal with the credit shelter trust. The rules in that article I referenced from earlier this year that I wrote, that deals with the $1.5 million trust. That's a good question. That's how it works. Today, again, I keep saying $5.5 million, but if your client died today, it's $11.18 million.
Thank you, Jim. And our next question refers back to slide number 38, so I'm just going to get us there. Okay, and the question is, are you talking now about a kid giving money to a parent to put in parent's trust? What is the point here?
No, well, yes, I'm talking about trying to get basic. So in other words, I'm sitting there, my dad is 88. Okay, my mom is 88 and not in good health. So I might say if I have a bunch of appreciated stock I might say I'll gift that to him, and let's say my dad's estate is well under the exemption. I might gift that to him. You can gift it outright to him, but most people would rather not do that because you lose total control over it. He's subject to creditors, et cetera, et cetera. So you'd gift it to a trust, an irrevocable trust that you'd set up for him that gives him a general power of appointment to creditors when he dies. So the idea then is that when he dies, those assets are included in his estate, but he doesn't pay any estate taxes because his estate's way under the exemption amount. But the trust comes back to me or from my family, and we can use the assets. But as a result of them being included in my dad's estate, I now have a basis step up, so I can sell all those assets tax-free, completely capital gain tax-free, yet still have access to them. So that's called upstream basis planning, which really wasn't present before because you couldn't really do techniques like that when we had small gift and estate tax exemptions. But now with these large exemptions, you just kind of go through your clients, and whenever you have a client that has a hefty stock portfolio and says, boy, I can't sell these things because I pay all this tax, so I'm going to hold on to them. You say, well, are your parents alive? Yes. Well, you might want to think about doing this. Okay, but the reason again you use a trust is to keep more control over it. You don't want the spouse to be able to give it to other siblings of yours or something like that. I hope I'm answering your question, but yeah, that's exactly what you do. It's just that normally you wouldn't just transfer them outright to the parent because you create other issues that you don't really need to have. So what we do then is that's what I mentioned, that, well, it's possible. What if my dad dies within a year? And I said, well, you set up these special clauses that says if he dies within a year of me doing this, then the document for me, the trust for me is different than it would have been if he lives a year. And then, like I said, if you're worried about the IRS just tries to collapse all this thing and said this is all collapsible, like they kind of did in that one private letter ruling I said at the end, dealing with the one-year rule, you may want to have this, if it were me, I'd have the parent actually do something, like take some withdrawals from it, exercise some powers, do some things in there to show that, no, I wasn't just your puppet. I did stuff with this trust. Okay? That's it.
Thank you, Jim. And our next question. I don't see the 2017 edition of your book on Amazon. Where can we buy it?
Oh, bummer. I can't get on Amazon right now, but if you can send me an email, my email address is on there. I'll look for it. I didn't know it disappeared. Sorry about that. And I will be coming up with a new edition, but it's not going to be tomorrow. I just got off teaching a course at Villanova on all this stuff. I teach all these concepts at Villanova's law school, and pretty time-consuming, so I have not had a chance yet to put out the new edition that has the post-Trump stuff. But I can tell you that everything in these slides, that's all up to date. So that forms I gave you, that all includes, everything I've talked about today includes the effect of the Trump tax changes, income and estate tax. But I apologize. But in the past, I've just gone to Amazon and I type in optimum estate planning and Blaze, and it comes up. But they could be out. I don't know. I'll check on it. Okay, so if you're interested in the book and you can't find it, send me an email and I'll check on it for you. But again, what I did was I don't know how Amazon works, is I priced the book the very minimum price they allow. My goal is not to make money on it. My goal is just to exchange ideas with other estate planning attorneys.
Thank you. And our next question refers to slide number 42. I'm just getting us there. And are you talking about a joint trust here?
It is a joint trust, But I guess what I'm trying to emphasize is that when you say joint trust, this is a joint irrevocable trust, although we do have provisions in it which each spouse can revoke their asset. What I'm trying to explain is that you can't just say joint trust because there's 50 different ways you could draft a joint trust. It's the way it's drafted, and all it really is a joint account. There's a bunch of money. You put your stocks in there. Your husband and wife put your stocks in there, and all you say in English is either of you can just take any of these stocks and run. And the other spouse has no rights in it. And you won't see that written about much, okay? But this is what this technique's all about. It's just putting assets in joint trust. Each spouse has unlimited rights over that trust, and as a result, the entire trust is includable in the first spouse that dies death, and that's why you get basis step up. And again, the reason the 1-year rule is avoided, that's cited in these other private letter rulings, recent private letter rulings, is because there is no transfer. In those cases, they're talking about a gift. The assets went to a bypass trust or something when the first spouse died. That doesn't happen with this trust. Nothing happens with this trust. Each of you had a full right to withdraw it when you're alive, and now the survivor has the full right when you die. It's that simple. So it's a good technique only because of the reason it's more recent and discussed more recently is because it's a good technique because of the high federal estate tax exemption. See, in the past you wouldn't want that. So I don't want all that money in the survivor's estate. I want half that money or whatever going into a bypass trust. But now, in most cases, you don't need that anymore. So you don't need to create the issues that were in all these private letter rulings. You can avoid them all by going this route. And that's all I'm trying to, again, you don't have to do it my way, but I want people to start thinking about that. It's a different approach than in all these private letter rulings that say it doesn't work. It's not the same approach. There were joint trusts there, but in those joint trusts, what happened when the first spouse died was completely different to what does not happen with this trust.
Thank you, Jim. And our next question. What is that one-year rule? Please explain more simply. I see a lot of old clients who are dying.
Yeah, that's in 1014E of the code, and the rule is just that if I transfer assets to someone and then that person dies within 1 year of my transferring those assets to that person, and the assets come back to me, then there's nothing wrong with it. It's just that I won't get a basis step up. You know, the IRS is trying to avoid these deathbed games that people play. Let's just put all the assets in this dead guy's estate, okay, and then he'll give them back to us, and we'll all get basis step up. So they tried to avoid that with this 1 year rule, and that's all that is. And the most important part about that is that I think that there's very little written on this, but surprisingly, there's very few cases on this. But if you look at the legislative, if you go all the way back to the legislative history of that section, and I think it's cited in my book, it says that Congress says that we're only talking about to the extent the asset comes back to you, you don't get a basis of it. To the extent it does. So if you think about it, the asset comes back in a trust for you, and you draft the trust in a very discretionary manner, and this and that, and the remainderment and all this kind of stuff. You start thinking about it. Go, well, what's really my interest in that trust? What's really my actuarial interest in that trust? And you make it very small. So then, based upon the private letter ruling I cite, they say, well, to the extent that it came back to you is very small, and so therefore you're going to lose basis step up only on a very small part of the trust. So as a result of that private letter ruling in the legislative history to 1014E, to me it's a no-brainer. You should always be looking at these things today. And again, you couldn't do this as much before because of the smaller gift tax exemptions and estate tax exemptions. That's why you didn't see a lot written on it, because you couldn't really do it. But now you start going through your client list and you say, wow, I can do this with all kinds of clients, okay? Because I'm not really worried about the gift and estate tax issues.
Thank you. Can a surviving spouse use the ascertainable standard power of invasion to take apart a credit shelter trust? And if so, what basis will the in-kind distributed asset have a carryover basis?
Yeah, I think what the person's asking is that, so there's an existing credit shelter trust, and it says the trustee can encroach for an ascertainable standard. And I think what they're asking is, can we go under that power and distribute some assets out to, because that credit shelter trust is not going to receive a basis step up when the spouse dies. So can we go under that ascertainable standard and make some distributions out to the spouse, and then now the spouse will have those assets in their estate, and as a result, there'll be basis step up. And the first question is, well, you just got to kind of use common sense on that. And is it for support if I'm giving her $500,000 of stock and she just puts it in her Edward Jones account? So that's the call on that. It's not that easy. We do it sometimes, but it's difficult. The issue on that is that on basis, the general rule is that, and this is where people get kind of confused on that, is the general rule is that no, you will be a carryover basis as to you, so the spouse will take the trust basis unless the trustee elects to recognize gain. Most of the time, you would not recognize gain today, and the reason for that is that that could cause, as most people know, the capital gain rates on trust get to the highest level at just $12,500, where for a married person or even a single person, you have to have $500,000 to have the highest capital gain rate. So most of the time, the trustee would not make the election. You would take carryover basis. You would then hold those assets till you die, and then your heirs would get a stepped-up basis. Okay, but I understand what they're saying, but you can see how it's difficult to argue I'm distributing $300,000 of stock for your support, and all you did was just put it in your bank account. Now you can argue, well, it's helping me because that allows me to use some other assets maybe that I have that I don't have gain on. So it's helping my support because I can now use these other assets and not deplete my reserves. And in other words, I can use cash where there is no gain, and you can make that argument. You can kind of make those stretches. I would say one thing that we've done several times, though, in smaller bypass trusts is that we've terminated them completely under that same theory. And you say, well, why is that? You just completely terminated this $400,000 bypass trust under the argument that it was maintenance and support and healthcare. And we say yes, and the reason for that is no document that I've ever seen that says maintenance and support healthcare during 2018. It's just for the surviving spouse's maintenance, support, and healthcare. Well, if you argue that if we keep the trust around, we're going to have to pay all these administrative fees. We're going to have to pay much higher tax rates, et cetera, et cetera. And so we don't really need the trust around anymore for its main reason, which was the estate tax protection. So in order to provide more long-term support for my spouse or for healthcare, et cetera, we're going to terminate it, again, to avoid all these trust administration expenses, high tax rates, et cetera. To me, that's a perfect argument. That is a distribution for maintenance and support healthcare. You just got to outline it, put a little paragraph together, say, trustee says, this is why I'm terminating it, because we think in the long run, the surviving spouse is going to have more money by avoiding all these taxes and fees.
Thank you. Next question. So the AB trust for each spouse is not good for basis step-up. I usually set up a trust for each spouse without AB trust since my estates are under federal exemption. What is the most simple way to get stepped-up basis at death of second spouse? If you use separate trusts, I always use separate trusts because it's better for Medicaid planning.
Yeah, good idea. No, I think the simple way is what we just said is that you just make sure that there's a conditional general power of appointment at the death of the surviving spouse. So I think what they're saying is I'm using separate trust. I'm going to, by the way, too, you got to look at that law pretty closely, because if you're doing it for Medicaid planning, the issue would be to what extent is that credit shelter trust consider a resource of the survivor, even though you put all these discretionary language in it, because some of the provisions say that the trust has to be established by will. And if you establish it under your trust, are you establishing it by will? And so we have special language on that to make sure that if we're worried about the Medicaid issues, that we have it essentially established by under a will. And so I just want to warn you about that. But yeah, that's how you do it. And then in that trust, this is what the first part of the program was today. You just be sure that there's a power to appoint to creditors. We do have that clause in there, and this is what someone else asked during the program. Well, can't Medicaid come after that trust, and if I have a power to appoint to creditors of my estate? And that's why I'm not sure of the answer. I would argue no, but you could argue yes, and that's why we have a clause in there that says, but to no extent, okay, can the beneficiary appoint to satisfy these Medicaid obligations. Okay, so in English, and if that means, well, we don't get basis step-up, then we don't get it, because, again, we would rather trade that basis step-up, loss of basis step-up, we'd make that trade any day for a complete loss of the assets by having to pay them back to the state. Okay, I hope I answered your question. Go ahead and email me if I didn't answer that very well.
Thank you, Jim. Pardon me, our next question. Is a general POA given to the surviving spouse? Yes, I also use testamentary SNTs for Medicaid.
I don't know what that means. The spouse has a power to appoint to creditors, which is a general power appointment. Is that what they're asking in the bypass trust?
Well, the actual question is the general POA given to the surviving?
Yes. In a credit shelter trust, yes. But it's, I want to make clear that although that was the example that I flowed through and I showed you all the forms, that same language is used for kids trust too, and that language is all in the book. But the same type of language is used for kids, so it's not just for the spouse. But yes, the power appointment language is used in the credit shelter trust.
Thank you very much, Jim. There are no further questions. And ladies and gentlemen, thank you. We hope you have enjoyed our national webinar, Minimizing Tax on Trust Transfers Through Basis Adjustment, Estate Asset basis management, trust transfers, credit shelter trusts, and postmortem actions. If your question was not answered, you may email it directly to our presenter, and his email address is included in the presentation materials. If you are seeking continuing education credit, you must verify your participation in this webinar by completing and submitting the attendance affirmation and evaluation after the program. A link to this form will be included in the thank you email that you will receive immediately following the program. As long as you have registered and paid for this program by 5 p.m. today, you will receive your certificate of attendance within 24 hours. If you have any questions about continuing education credit for this webinar, please call our Continuing Education Department at 404-881-1141, extension 2. Again, for those of you seeking standard tax or accounting continuing education credits, you will need to have responded to all the pop-up prompts. Today's participants can order a recorded version of this event at a special attendee price. Please call customer service at 800-926-7926, extension 1, or visit Stratford's website at www.stratfordpub.com. And if you're not yet a Stratford Annual Pass holder, try the CLE Individual Annual Pass. You can get all your CLE credits for one low price. Simply respond to the email you will receive after the program. Stratford would like to thank you for your attendance. To end this call, simply hang up your phone. Thank you and goodbye.